Welcome to Insights and Indicators. I'm Jason Thomas, Carlyle's head of global research and investment strategy. And in this podcast, I share our observations and opinions on the economic landscape, as well as insights from research being conducted by our team here at Carlyle. Today, I'm joined by Ruulke Bagijn, global head of investment solutions and head of AlpInvest, Carlyle's dedicated private equity asset manager that invests in primary and secondary fund investments, direct co-investments, and portfolio financing. I'm very excited to have the opportunity today to tap into her over 20 years experience in global investments and deep knowledge of private capital portfolios and market dynamics. This episode was recorded on December 13th, 2024, and the discussion reflects composite portfolio data and analysis of recent government reports that are accurate as of that date. Before diving into our discussion with Ruulke, I just wanted to give an update on what we're seeing in the portfolio. So it's very common, of course, to describe the stance of monetary policy in the US as restrictive. Fed officials use that word regularly. But when we think about what restrictive monetary policy is supposed to imply about economic activity, we should be observing demand destruction. We should be observing policy that is actively exerting downward pressure on inflation. We should be expecting to see signs of discounting, management teams having difficulty maintaining margins. In fact, we're not really seeing anything of the sort. Over the past 3 months, in fact, we've seen margins that actually appear to be widening very modestly, but again, in a direction of greater operating margins. This is partly due to a widening of the pricing power. So the final sales price that we're seeing in the portfolio is actually about 1.8 percentage points above the increase in input costs, including labor. And that's about 130 basis points of widening in the spread, this pricing power gauge, relative to what we observed in August. Also, it appears that Q4 annualized growth in corporate revenues in the United States, based on our estimates derived from portfolio company data, will be in the neighborhood of about 6%. That is up from growth of about 4.5% in the third quarter of 2024. So again, interesting to consider these data in the context of the way that monetary policy is typically described. I think the Fed is very likely, of course, to cut rates by 25 basis points next week. But this is not something that necessarily follows from the current data. I think it reflects the decision made among the FOMC in the summer to take base rates down by about 100 basis points. In July, it looked as though inflation was settling into a rate of about 2.5%. That meant that current base rates at the time, 5.33%, left real interest rates nearly 3%. I think virtually everyone could agree that real interest rates of 3% was genuinely restrictive, and that there was no longer a need for that degree of restriction. So I think that once this 25 basis point cut is enacted in December, they will have achieved that 100 basis point reduction in rates. And I think that thereafter, there's no longer broad consensus on the FOMC for any additional cuts. Now, the data could change and opinions could change as a result, but I think we're essentially at the end of the road. This mid-cycle, this mid-course correction of 4 cuts, 100 basis points, has now come, and by next week will have gone. And I think it's time for market participants to start to think less about the looming reduction in rates and start to think about getting business done, thinking about pricing decisions, expecting that this level of rates is likely to persist through perhaps the first half of 2025. So with that, Ruulke, again, thank you for joining us today.
Thanks a lot, Jason. And it's interesting what you bring up there, because I actually think that that's exactly what we're starting to see now. It's not only the rate expectations, it's actually also the outcome of the elections. I think what we see in private equity is broadly what we've seen in equity markets. And that's a significant improvement in investor sentiment. And interestingly, in our own portfolio, we have seen a significant increase in number of exits over the past few weeks. And that shows you that the bid-ask spread between sellers and buyers have come down and deals are now getting done. And it's not because prices are lower. In fact, prices are still high. It seems to be much more about the improved outlook of investors. And to the point that you just made, it is also that most of the rate adjustment now seems to be done. So there's really no reason to wait anymore to do deals. So I think if you take all of that together, that already has translated into more deal activity.
Well, that's great. I mean, there's probably no one better to speak about broader sentiment or activity than you. You've deployed more than 11 billion over the last 12 months. And I guess the thesis that you suggest, you point to, I've perceived over the last 2 years, really starting in early 2023, that many would-be sellers have been instructed by advisors or maybe just looking at futures markets to delay sales processes because of the expectation that 12 months, 18 months in the future, base rates are going to be much lower, financing conditions will be much improved, they'll be able to get a much better price for the asset then. And now, it seems that we've finally reached that end point. People are now at the stage where they recognize that financing conditions not only have improved, much of that, of course, associated with very significant spread tightening, but also now this non-trivial probability that 12 months from now, if we're having this discussion in December of 2025, actual all-in financing costs could be higher than they are today. And I'm just wondering, do you get the sense from market participants that there's this idea of striking while the iron's hot, while these credit markets are wide open, spreads are as tight as they are, that there's the broad improvement in sentiment, just that the need to actually get these processes going and accelerate them in some cases?
We certainly see that. I mean, markets were already in a much better place over the past few months than they were in the last 2 years. And what we've seen is that market participants have been very active in refinancing existing debt of portfolio companies. What we also saw until into the third quarter is that deal activity and liquidity in our private equity markets improved, but only very slowly. And it wasn't lack of trying. GP's been very active. They've been creative to create liquidity for their investors through minority sales, through continuation vehicles, NAV financings. And you mentioned that credit markets were so wide open. Financial sponsors took advantage, and we've seen a record amount of levered dividend recapitalizations. But the deal activity really stayed behind. What is now so interesting that what you say in the acceleration that we're now seeing is more recent. I spoke to our capital markets team, and since the elections, they've even seen more busy markets than before. They mentioned that a lot of financial sponsors are currently assessing the secondary market, doing block trades, and just last week, 29 transactions priced, generating 13 billion of proceeds, and that's a big number. The team expects that the year ahead is going to be a big year, both in IPOs and also for M&A.
Of course, with the rate adjustment maybe largely concluded, perhaps there's another 25, 50 basis points. But again, this seems to be close, if not at the end of the road here. Base rates, of course, are materially higher than they were prior to the onset of the pandemic, certainly relative to 2021. If you looked at futures pricing in 2021, base rates were supposed to remain essentially near zero through the end of 2024. So this is a shock. And I'm wondering, to what extent do you worry that this is going to impact private equity returns, or how should investors be thinking about this adjustment?
Yeah, that's a good question. I mean, generally, higher rates mean higher cost of borrowing, and therefore we'll likely see lower leverage levels if rates go up. And the question then is, what does that do to buyout returns? Now, what we find is that private equity returns do not so much depend on leverage. The leverage in private equity deals have decreased significantly over time, and it's interesting to look at that development. In the early days of private equity, so that was in the late 80s, equity contributions were on average only 10%. So deals had very little equity and a whole lot of leverage. And then equity contributions have gone up over time consistently, and we see equity contributions being over 50% today. And that did not lead to lower returns. And that's an important conclusion, I feel. And that is because a big trend is that private equity has changed, much less dependent on financial engineering and financial leverage than it was in the earlier days. And much more of the value today is created by improved governance and operational improvements. It's also what we see in research. BCG has issued research that revenue growth and EBITDA margin growth have contributed nearly half of value creation in leveraged buyouts. And that's a tripling from the 80s. It's interesting if you look at our own portfolio, the Alpinvest portfolio, you look at the co-investments that we have, and you only look at the best deals. That's what we call home run deals, deals that do over 3x money multiple or over 30% gross IRRs. You can see that those companies are not highly leveraged and use the cash flow for debt rate pay down, but the cash is really used to fund the growth of the portfolio company. And I think that supports the same point that I just made. So I think overall, how to think about higher rates. Higher rates can impact the performance of existing assets for sure, but the expectation is that private equity will continue to outperform.
So let's talk about the outperformance. Obviously, when a benchmark is the S&P 500, given the extraordinary performance over the past year, really the very impressive performance since that market bottom in October of 2022, that's proven to be a very, very difficult comp. I'm wondering how investors, when they look at their private portfolios that maybe have lagged the S&P 500 over the last year or whatever the relevant horizon has been, how are they thinking about the sustainability of the S&P 500's performance? And again, how are they thinking about their private allocations in relation to it?
Yeah, I think that's a great question. We have a lot of conversations about that. And it's also become a little bit less easy because the S&P has performed exceptionally well. But you know as well as I do that that's only half the story. The comparison with the S&P today is not that straightforward anymore. Most people know that the S&P performance that we've now seen is in large part driven by the Magnificent Seven. 7 large tech companies driving that returns. That also suggests that there's much higher concentration level in that return. And to give you the number, those 7 stocks accounted for more than half of the recent returns of the S&P 500. And something that I didn't realize yet is that how new that phenomenon actually is. When you compare value-weighted and equal-weighted returns, that becomes very clear. For the last 10 years, value and equal-weighted were more or less the same. But then since the market bottomed in 2022, value-weighted returns outpaced equal-weighted by a stellar 20 percentage point on an annualized basis. That tells us that we have to look at things in a different way. And I find it, for example, also very insightful that if you compare US buyout returns with a broader public index like the Russell 2000, you get a different picture. The Russell 2000 yielded a negative return of 2.6% over that same 3-year period. And then at once, the buyout returns of 9% over that period compare very, very strong. I think there's more discussion about what's the right benchmark, and it's been less clear-cut, but we really have to look at that in a different way. Now, there's one last point that I want to make on this topic, and that is that it should also not surprise us that private equity returns have been affected by the economic cycle. Private equity is not immune to changes in financial markets or rates, and cyclical variations will continue to persist. But I generally believe that long-term investors shouldn't be too concerned about that. If you just look over a longer period of time, in the best years, private equity delivered median returns over 20%. And if you look at the upper quartile ones, it was over 25% net returns. And in the worst years, private equity has delivered 8%. And that's not a bad deal. I believe that overall, private equity has really done what it has promised to investors.
So I do want to ask a question about secondaries, because the role of secondaries, I think, has been glaringly obvious over the last 2 years, just given the slowdown in momentum and exits and IPOs and just broader M&A activity. But now that there's a lot of optimism about the potential to exit through trade sales, to exit through IPOs, how should we think about secondaries and portfolio finance and the role that these tools are going to play in a market that everyone hopes is much more buoyant than we've seen over the last 2 years?
Yeah, I think there's 2 aspects to this. One is that indeed secondaries have played, and portfolio finance as well, by the way, have played a very significant role in the adjustment that we're now seeing in the markets and have been providing liquidity to LPs and GPs when that liquidity wasn't there. But it's important to understand that there's a lot of pent-up demand. That is not going to clear immediately overnight. It will take time before all these adjustments work through the market, and there's pent-up demand, we think, at least for another 12 to 18 months. Having said that, I think it's also important to understand that Secondaries deal flow does not depend on dislocations like today.
Mhm.
Secondaries is a younger market, but it's been around for more than 20 years, and it's grown very significantly on the back of structural trends. And those structural trends are the growth of private equity itself as an asset class, but also increased adoptions. LPs and GPs are increasingly using the regular course of managing their portfolios, secondary tools to create liquidity, and that will continue over time. And so far, capital formation has not been able to keep up with the growth in the market. And that means that also for the coming period, we expect that the risk return will remain very attractive in that segment.
So we've talked about the improved sentiment in the market, hopes for increase in deal flows, exits, et cetera. What are you hearing specifically from LPs about how they're approaching their portfolios entering 2025? How are the allocation decisions being shaped by the changed attitudes, the new information, et cetera?
We've seen improved sentiment amongst LPs. More LPs now expect to increase their private equity allocations. And the PAI survey, for example, most recently shows that 45% of LPs plan to increase the amount that they're going to invest in private equity in 2025. And that 45% compares to 31% last year. So that's a significant step up. And LPs generally expect that private equity will improve in terms of performance and will do better than the benchmarks that they have. 38% of LPs expect that private equity investments will exceed the benchmark over the next year, and that was 23% last year. So I think those statistics speak for themselves.
So given this concentration risk in the S&P 500, is it possible to have a diversified portfolio today without a sizable private allocation?
Well, I think that's one of the biggest benefits of private equity, that it gives you a much broader diversification. What's your answer to the question, Jason?
No, I think that it is fascinating to consider when you invest in a ticker, an index fund, that you have 32% of the value is concentrated in a handful of stocks. And I think that over the last year, what we've seen, at least in my view, is a change in business strategy among some of these very large, the mega cap tech companies that have actually moved in many ways away from a virtual or asset-light business model into becoming the largest CapEx investors in the world. They have 4 companies that invest in data centers: Meta, Amazon, Alphabet, and Microsoft are going to spend $250 billion over the next 12 months on hardware like GPUs, CPUs, infrastructure, and then the related applications for data centers to train these foundational and generative AI models. Then, people refer to these as, of course, AI manufacturing facilities. And so I think that we do not yet know what the return on this enormous capital deployment is ultimately going to be. And so to me, if you invest in the S&P 500, that's a large share of institutional portfolios, you're really making an outsized bet on all of this going according to plan. And I think, again, that's perhaps a risk that is less appreciated among broader market participants.
I agree with that. And it's also part of a longer term trend that the number of listed companies have come down. Number of private equity backed companies in the US economy has significantly increased over time. These trends are almost crossing each other. I think it's right that you make a point that with private equity offering much broader diversification at this point in time compared to what it was in the past.
Great. Well, thank you so much. I've really enjoyed our conversation. And I thank you for making the time to join me today.
Thank you, Jason. It's a pleasure to do it with you and to participate in this podcast.
Well, on behalf of the team here at Carlyle, thank you for listening and happy holidays. I hope you'll join us in 2025 for our next episode of Insights and Indicators.